Perhaps you could start by explaining what's going on with this pullback rally that we're seeing across global equities. I mean, from the lows of March, we've had a significant rally, and all around there's been so much gloom and pessimism. What do you think is going on here?
Well, it's all about money supply. As you know, the Fed in the US has been trying to pull back on money supply, and they've been doing that, and they've been raising interest rates. But in the meantime, there's still an awful lot of money left out there. And one of the things that's happening is that people are finding that with higher interest rates, they can put their money to work on fixed deposit instruments, bonds, who are paying higher rate. And also, this extra cash they get can be put in the stock market. So it's really a sort of a respite from what's been happening with the money supply. So we expect money supply to continue to decline, but not at the rate that it was earlier this year.
So would you classify this as a relief rally or something more durable than that?
I wouldn't call it a relief rally necessarily, but I would say that we're in a better shape than a lot of people think we are, simply because there's an awful lot of money being spent by the U.S. government to begin with on such things as space, on such things as semiconductors, and a number of other areas. So I think that means that the economy is a lot better than people imagine. And as you know, employment is at a good level.
So you're not in the camp which believes that the US economy is hurtling towards a pretty bad recession, because all this, the news from the banking sector over the last couple of months led people to believe that such bank failures typically occur before the US goes into recession. Do you think that's not the right way to think?
No, the bank problems were simply the fact that interest rates went up. The banks were holding long-term maturity bonds, which were losing value. And there was a panic created by the fear that these banks were not able to make good on their deposits. That's over now. The Fed has moved in very aggressively to help the banks. And they have supplied money to the market in order to ensure that happens. That has nothing to do with the health of the economy. Health of the economy is really based on what's happening in the industry and service industries as well. And with the government spending an awful lot of money in a number of directions, and with unemployment at a relatively low level, we think the U.S. economy will do fairly well this year.
And would that translate into a positive return from the stock market too, you think? Because, I mean, till even last month, most analysts seem to believe that this will be a difficult year to make any kind of positive returns from equities.
Well, the stock market actually reacts ahead of what's happening in the economy. And of course, you know, they were expecting a downturn as a result of these problems with interest rates. So the market already has had this correction. I think going forward, the market is telling us that it's not completely certain that the economy doing well, but it's certainly not telling us that the economy is doing badly, because you can see the market has recovered a little bit, and there's sort of a sideways movement in the market, which indicates that the expectation is that the economy will do fairly well going forward.
If you like the video, do like, comment, share and subscribe.